Government bonds. In this video, we go deeper into government bonds, a very actual topic these days. If you follow the financial news, you know that a lot of talk is going on about monetary policies and interest rates, which are directly connected with the bond market. Let's see how. Yields and bonds. Interest rates strongly define the price of bonds, as today's interest rate is the alternative cost holding of any bond. That means if yields move higher, it will cause bonds to fall as their fixed payments. Of course, bonds that have floating interests have an advantage here. Will be worth less. Following one of the benchmark government yields, like the most widely used 10-year U.S. Treasury yield, or the German counterpart of it, gives you a rough gauge of where the bond market is. That is true not just for sovereign bonds. Of course, all bonds have their own price factors too, like the given country's own interest rates and the fiscal condition of the nation, in the case of government debt. But general trends are well discernible by looking at these benchmarks. The chart above shows what I meant last week by the extreme situation of the bond market. The U.S. Treasury yields are at the lowest levels in the last 150 years, meaning that bonds are at their highest level in that period. The effect on stock markets. But the riskless rate, that's how the U.S. Treasury yield is often referred to, has a profound effect on stock prices too, for exactly the same reason. If the riskless return you get is higher, you will want more returns from riskier stocks too. Therefore, low yields are good in general for stocks, and on the contrary, high yields create less demand for them. That's one of the reasons why you should care about Treasury yields, even if you don't plan on investing in bonds. And here is the great misconception about bonds that is still common knowledge for even a lot of professionals: that stocks and bonds move in opposite directions. That is a dangerous half-truth, as it is sometimes totally wrong. Just look at the chart of the S&P 500 below. You can see that since 1982, stocks have gone 20 times in the US, while bonds had their greatest bull market in history. And they can and probably will fall together, making diversification a challenge for every investor.